Hi there, good morning. You're watching Power Breakfast on CNBC TV 18. I'm Mangla Malu. With me is Anisha Jain. Anisha, good morning. Yesterday was a bit of an insipid sort of trade, but we've been in a limbo, if you must, in a range over the last few trading sessions. The good news is the fact that the US markets, they're doing fairly well. The first 5-day winning streak in 2019.
Oh, well, yes, the US markets are doing well, and we have the earnings season to really track. TCS reported kind of the insipid numbers that you were talking about as well. Let's see how that one reacts. And of course, Infosys comes out with numbers
have,
today.
10%
oh, well, yes.
Index.
So let's keep an eye out on the IT space today, how those stocks perform. But let's kickstart the show with the top headlines. US market ends higher for the 5th consecutive session. Dow and S&P 500 exit correction territory, while Jerome Powell reaffirms Fed's cautious stance on interest rates. Asia starts on a positive note.
After the GST Council's 32nd meeting, Finance Minister Arun Jaitley rules out further rate cuts till an increase in revenue. The Council decides to set up a group of ministers to look into the real estate issue.
TCS delivers a mixed bag in Q3. Dollar revenue and constant currency growth largely meet estimates, but the margins miss expectations due to cross-currency headwinds and higher cost of doing business.
After TCS, all eyes on Infosys today. The dollar revenue growth seen at 1%. Key will be to track the FY19 guidance and any announcement on the company's buyback.
Well, also watch out for November industrial production data due later this evening. A CNBC TV 18 poll sees a sharp decline to 3.84% versus 8.1% in October. This on back of a high base due to the late festive season in 2018.
Prime Minister-led selection committee sacks Alok Verma as the director of CBI just 2 days after he was reinstated. Prime Minister Modi and Justice A.K. Sikri vote for his removal. Sources say Congress leader Mallikarjun Kharge opposed the move. More on that later on the show. Well, first up, a look at the Asian markets, and they're doing fine as we speak, and that's primarily on account of the 5-day winning streak that the Dow Jones has posted. The Wall Street is doing fairly well. 100-point move out there. There was improved investor sentiment following the overnight gains coming in on Wall Street. So the Japanese index doing fairly well. The one stock which is taking that Japanese index higher is Fast Retailing, the company that owns the brand Uniqlo, which is higher by about 4.5%, and that's primarily on account of higher retail sales in this quarter. And this is despite the fact that Japanese household consumption or household spending declined 0.6% as against estimates of just a 0.1% decline. Overnight, we saw a cut in Macys on the Wall Street, but no bearing to the Asian retailers from there. The Korean index absolutely flat as we speak, come off the highs of the day, has been underperforming the other Asian peers, but big moves on both Straits as well as the Taiwanese indices, both high by almost 0.6 to 0.75%. On the back of that, the SGX Nifty indicates a start yet again closer to the 10,900 mark. Key will be to sustain those levels. Remember, over the recent past, in the last 2 months or so, we haven't convincingly broken above the 100-day moving average, which currently sits at 10,875 thereabouts. So 30-point bump up to start. Crude oil at 61. Let's see what happens.
Okay, so Asia is moving higher. That because the Wall Street saw some gains for the 5th consecutive session, with the Dow and S&P 500 exiting the correction territory. The S&P and the Nasdaq ended with gains of almost 0.5%, while the Dow rose around 120 points. Now, gains were, however, capped as investors dealt with a mix of optimism over the progress in trade talks and the disappointing holiday sales data. Remember, the street was also watching out for the comments coming in from Fed Chair Jerome Powell. CNBC's Contessa Brewer gets us a wrap of all that transpired on Wall Street yesterday.
U.S. stocks finishing higher today. The Dow added 122, the S&P up 11, and the Nasdaq higher by 28. The U.S. weekly jobless claims fell more than expected last week. The fall points to a strengthening labor market that could further ease concerns about the economy's health. Shares of Macys down 18%, their biggest loss ever, after the company reported weak holiday sales results and cut its 2018 outlook. The retail wreck has spread to other stores, dragging Kohl's stock down nearly 7% and Target down nearly 3% on the news. There will still be a stadium with Oracle's name on it in the Bay Area. AT&T Park, home of the San Francisco Giants, will soon be called Oracle Park. Oracle bought the naming rights for 20 years at a price tag of $200 million. It comes as Oracle is losing the naming rights to the Golden State Warriors home stadium in Oakland, California. That franchise is moving to the Chase Center in San Francisco. That's what we're watching here in the U.S. market. We'll send it back to you now in Mumbai.
All right, thanks a lot for that. In fact, it'll be very interesting to see what happens in the U.S. consumer spending, because while Macys is not doing well, even the aviation company is not doing well. Yesterday, we had American Airlines slash their guidance, and this after Delta slashed their guidance in the previous week. On that note, let's hear out what experts have to say about the road ahead for the U.S. markets, as well as some earnings expectations.
The confidence is this, that bottoms are built, everybody will tell you something differently, but over time. If the base of earnings is above zero for 2019, then the bottom so-called numbers are in. We'll get a lot more of that information coming out in the next few weeks. You're going to hear a lot of things thrown into the kitchen sink, so the numbers are low enough so you can actually create a beat for the rest of the year. Markets got so low as it relates to the multiple, down close to 14 times earnings. We hadn't seen that number in a long, long time. But sentiment was so poor. Almost every sentiment measure you could look at was at its low, to the point where, is it a bottom on numbers? It's tough to tell, but it's a bottom on sentiment.
I think we're kind of in this consolidation phase right now until we get earnings. I mean, we have to wait on Tuesday. Tuesday, things can totally change. We have to hear what the banks have to say and to see if they can continue to rally or if they actually stall. I think that's going to be very, very telling. What I do think is different between this year and last year heading into earnings, expectations are still fairly muted. Even though we have bounced off the lows, we're still off the highs. We're still at attractive valuations. Last year at this time, we were euphoric. We were expecting great things from earnings. So I like the risk reward. I like the setup. We'll have to see how companies, especially those that have international exposure, we'll have to hear what they have to say, especially about China.
Okay, meanwhile, market was cheered by Fed Chair Jerome Powell's comments, who during a discussion at the Economic Club of Washington stressed that the central bank will be flexible and patient on monetary policy as inflation is under control. CNBC's Steve Leisman filed a report on the same.
In his third public appearance in the past month, Fed Chairman Jerome Powell sat down for a chat with private equity mogul David Rubenstein and tried to ease market concern over the rate outlook. Powell suggested the Fed is in no hurry to raise interest rates.
I think we're actually in a good place. I think where that leaves us, particularly with inflation low and under control, is we have the ability to be patient and watch patiently and carefully as we see the economy evolve.
The Fed chairman repeated that he sees the U.S. economy as strong and expects momentum from 2018 to carry over into 2019. His biggest concerns, weaker global growth, trade tensions, and an extended government shutdown. But markets sold off during Powell's comments, though several factors were in play, including a soft 30-year bond auction and a tweet from President Trump announcing he would not be going to the Davos World Economic Forum this year because of the shutdown. But some pointed to Powell's comments saying the balance sheet will be substantially smaller than it is now.
We wanted to have the balance sheet return to a more normal level, which is a level no larger than it needs to be for us to conduct monetary policy. Don't know the exact level. That will depend on really the public's appetite for our liabilities, specifically currency. To us, that's a liability, and the public has a large appetite for currency, and also reserves and other liabilities. So it'll be substantially smaller than it is now.
Investors are watching what the Fed does with its balance sheet because of its potential to raise interest rates. The average market expectation is for the balance sheet to decline to around $3.5 trillion from the current level of $4 trillion. Investors, though, will have to wait until the next public appearance or press conference by Powell to find out what substantially smaller means. Steve Leisman, CNBC Business News.
I just don't think this is quite as unusual as most people think. This is kind of a normal late cycle dilemma for the Federal Reserve. Do they raise rates? Do they not raise rates? What's the stance of monetary policy in the late cycle environment? We look back in history and it looks so obvious. Why didn't they do it? I think the deliberations and the terminology he's using fits very well with history and the dilemma that the Federal Reserve always faces in a late cycle environment.
All right, that's as far as Wall Street is concerned and the road ahead for that. But moving across the European region, markets ended with minor gains as investors focused on a lot of triggers. One of them was trade war developments and automakers. They were the worst performing sector in the European region. That's after announcing job cuts. So Jaguar Land Rover, for instance, announced a job cut of about 10% of its total workforce, as did Ford. So those are a couple of stocks that were in focus. And then coming back to the retail space, then the British Retail Consortium said that this was the worst Christmas that they faced in a very long time. But despite that, we saw shares of Tesco move higher because they updated the street on their quarterly performance, saying that while the sector did not do too well, they outperformed their competitors. So mixed views coming in from the European markets.
Okay, so that was about equities in the European market, but let's shift focus now to the currency space. The dollar has actually recovered from 3-month lows after Federal Reserve Chairman Jerome Powell said that the U.S. Central Bank intends to further shrink the balance sheet, suggesting it is not done tightening monetary policy just yet. The dollar index now has moved to the levels of 95.5 from the lows of 95 seen earlier.
In the world of commodities, crude oil prices inch up for the 9th consecutive session, holding near 1-month highs. But gains were capped as optimism surrounding the US-China trade talks faded a little.